Hello, this is Dean Malone, Comps of X. I hope you're doing well today and you're getting some good trades. In today's video, I want to speak more about the risk-on, risk-off trade. From the previous video, I received a number of emails from folks asking me if I would speak more about correlation of the various asset classes. You see, to have a risk-on scenario, what generally happens is folks have a more positive sentiment about the marketplace, a good feel that things are going well, and they'll step out of safer assets into more riskier assets like equities and world currencies. But yet, if there's fear in the marketplace and a negative sentiment, then those same investors will come out of the higher risk asset classes and move into safe haven asset classes or fixed assets like U.S. Treasuries. And today was a prime example of a risk-on scenario. So what I want to do in this video is talk about what took place today, and then we'll talk a little bit more about correlation and the impact of correlation in the risk-on, risk-off trade. Okay? So what took place today? At 8 a.m. Eastern this morning, the central banks of the world, the ECB, the Federal Reserve, the Bank of England, Bank of Canada, the Bank of Japan, and the Swiss National Bank took a coordinated action to boost market liquidity and reduce the cost of temporary U.S. dollar loans central banks make to other banks. This is what's known in the market as liquidity swaps. And they reduced it by a 0.5 percentage point. So why this coordinated action? It's simply an attempt to ease the financial strain on European markets and avoid a credit crisis which can potentially lead to a collapse in the European banking system similar to the 2008 collapse of Lehman Brothers. As a matter of fact, today there were whispers in the marketplace that there is a major bank in Europe that has a drawdown of a negative 40% in its cash reserves. That is startling. This could be the reason why the central banks of the world did this coordinated event to prevent a potential Lehman Brothers-like collapse. So what does this all mean? In short, the Federal Reserve agreed to provide a cheaper dollar funding to the ECB, which can then provide cheaper U.S. dollar denominated loans to European banks with insufficient cash reserves. And remember, the U.S. dollar is the world's leading currency for central bank reserves and is widely used in international trade. Okay, so that's pretty much what took place today, and it had a major impact on the marketplace from a risk-on potential. If we're going out there and we're cheapening the cost to loan from one bank to the other based on the U.S. denominated loan value, in some respects, according to a report by Reuters saying today's halving of the dollar swap rates between the Fed and other major central banks was a godsend for risk traders across asset classes. And today we saw the world equity markets, including the euro, the pound, the Aussie, they all made a sharp move up. The German DAX up 4.7%. The French CAC up 4.1%. The Dow up 3.3%. Let's take a look real quickly here at the Dow, and you can see the move up on the Dow here. The Dow taking a pretty strong move up since the 25th. Also take a look at the S&P 500. It too making an astounding move up since around that Thanksgiving Day holiday. But another good move up today, breaking above the 1200 mark to 1246 today. Strong moves up in both of these, and at the same time, let's take a moment and look at correlation here. Look at what took place in the marketplace. The pound and the euro both making very strong moves up. This move to the upside here, very strong move up. In this case, making a move of about 245 pips. Over here, making a move of about 250 pips in the euro dollar. And take a look at what I was talking about as the risk-on, risk-off currency pair, the Aussie yen. This too making an astounding move since the Thanksgiving Day holiday, right around 520 pips. Some astounding movement in the marketplace, a real risk-on move today, coordinated by the central banks of the world. Now, correlation, again, I mentioned, simply means that two assets tend to move together. When one investment goes up, the other goes up. When one goes down, the other is likely to go down as well. Now let me make something really clear. There has to be correlation in the marketplace for it to be a risk on, risk off. One of the questions I was asked today was, well, if my stock goes up or if my stock goes down, does that mean that that stock was risk on, risk off? Not necessarily. A stock of its own could be moving up and down based upon internal strife within the company or changeover in management, or maybe a new product introduction didn't go off as well or went off better than expected. There's all sorts of things that could cause a stock to move up or down. What we're looking for in the risk on, risk off trade is a correlation of events. So if we take a look, you can see the Dow making this strong move up today. Okay, 3.3% up for the day, and we can see the pound making a move up. We can see the euro making a move up. That is what I talk about correlation. Looking at different aspects of the marketplace making the same move. And again, taking a look at the S&P today, we can see it too making this move up of nearly 4% on the day. Coordinated event by the central banks, spurring on risk-on scenario in the marketplace, getting equity markets to move up as well as currency markets to move up, and we saw other world markets making movements as well. So be aware of the correlation that gives cause to the risk-on, risk-off trade scenario. Now, for those of you who might have missed out on my discussion of the risk-on, risk-off, I just want to give a real quick review of some of the reasoning behind the risk-on, risk-off. And that really boils down to central bank rates. What generally happens is when there's that good positive feel in the marketplace and positive sentiment that things are going well, especially if the U.S. markets seem robust or seems to be moving in the right direction, what will generally happen is investors will simply sell the dollar and move into higher risk investments like the Aussie dollar, the New Zealand dollar, the euro, the CAD. You see the interest rate here? And look at this. Look at the differential. Suppose for the moment you had dollars, but you knew that you could sell those dollars and buy Aussie dollars. Realize that that's a 4.25% differential rate just for holding that position. Now I understand there's flow in the marketplace of profitability and loss in the position that you hold, but if the market maintains a risk-on scenario like it did today from yesterday, you could earn the differential in the interest rates on top of the potential profit in the trade. So that's why I look at the Aussie yen as the risk-on, risk-off trade, because if I see world markets going up and I see the Aussie yen going up, I know that we have a risk-on scenario. At the same time, if I see world markets dropping and I also see the Aussie yen dropping, that means that there's some fear in the marketplace or some negative sentiment, and what's ended up happening is investors are coming out of the Aussie dollar here and moving into maybe the dollar or back into the yen. They're selling that higher risk asset and moving back into a safer asset like the yen. But my thinking is a lot of movement into safe haven is back into U.S. Treasuries because the U.S. government backs those Treasuries. Well, folks, I hope this answers a little bit more questions about correlation and its relationship to risk-on, risk-off trades. Well, folks, this is Dean Malone with Compass FX. I hope some of this information will help you in your trading. Just be aware of what's going on in the marketplace, and when you see multiple markets making similar movement, consider for a moment it might just be a risk-on, risk-off scenario, and you could take advantage of it based upon this information I've shared with you. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.